Welcome back to Inside Toronto Real Estate. I'm your host, Brian Prasanna. Tonight's show, we are asking the question, is Toronto in a housing bubble? With us tonight is Jas Grewal, mortgage advisor with the Callum Ross team, the #1 mortgage brokerage team in Canada. We have Ben Rabideau, a real estate blogger, also an instructor at Georgian College of Financial Planning and Psychology. We also have on the line Ben Myers, the Senior Vice President of Urbanation, which tracks the high-rise market in Toronto and the GTA. And we also have Don Campbell, the president of the Real Estate Investment Network. He is right now in Vancouver. So if you have questions and comments, give us a call, 416-446-7090. So let's do some myth busting. I went on a couple real estate blogs that were also talking that we're in a bubble. So I'm going to throw out some facts, and I want you guys to either say yay or nay and give why. So, Jas, I actually got this from the Capital Economics report. They didn't really substantiate it with any numbers, but they said that there are too many first-time home buyers putting in very low down payments, and we're teetering on the brink because of that. Yay or nay?
I don't necessarily agree with that. I mean, one of the things that what you have to understand is for the people who put low down payments,
yes,
we have the tightest controls over that. They have to have the best credit, overall, and verifiable income. So, I mean, part of that is you already have to have a pretty strong application just to apply. Another thing with regard to that is the mortgage insurers, CMHC, Genworth, and Canada Guarantee, they also have been, for the last couple of years, and Canada Guarantee not so much, but the other two have already been addressing that situation. So if you find people who have a little higher debt load and as well as lower credit scores overall, CMHC or Genworth wouldn't allow them to put 5% down. So, I mean, they've already kind of been historically hedging to protect with regard to that. It's not a matter of every single person who qualifies under the minimum Beacon score over 600 gets to qualify with 5% down. So they'll already trim that down with actually the loan to value and already make the whole situation a little bit more safer along
So
that
basically
way.
It's a little bit of conjecture. There's actually a lot of controls in place to ensure that these people could actually afford, and there's some buffer to protect them.
Well, absolutely. And I mean, part of what we have to understand is we can't become reflexive like in the States. What happened in the States? A lot of times in the last couple of years, people have been fearful of, oh, well, we don't want the big blow up happening in the States here.
Yes.
We already, that situation was never going to happen here because we never let people with no income and non-verifiable income and no credit get mortgages in the first place. Absolutely. And that's something what was widespread in the States here. We already had the controls. The people who could put the lowest down payment have to be credit worthy, have to have the verifiable income already. Yes, the actual percentage of people who buy houses with 90 or 95% loan to value has gone up. Yes. But still, if you look at the overall stats, the overall households in Canada, there's still about 70% equity in the average household across Canada. And that's pretty compelling overall.
A substantial amount of equity.
Yeah.
Ben Rabideau, so one thing from the Capital Markets report, we're seeing that the debt to income levels are high, and Canadians are taking on more debt. We may have surpassed or about to surpass the U.S. in terms of the debt that we have. Does that mean we're in a bubble?
Well, I think, there's a saying that people don't buy houses, people with mortgages buy houses, right?
Yes.
And I think if you want to understand whether or not we're in any sort of a bubble, you have to start with debt. And if we look at the debt measures, if we look at debt as consumer debt as a percentage of GDP, right now here in Canada, once you add our mortgage debt with our other consumer debt lines of credits and credit cards, we're about 95% GDP. Now, to put that in context, that's exactly where the U.S. was at the peak of their bubble. So again, a bit of an alarm going off there. Now, in fairness, our mortgage debt is lower than theirs was as a percentage of GDP. But at the same time, when you look at the tax regimes, mortgage interest is deductible in the U.S. So it does somewhat even out. I think, if I can address a couple of points that Jas made, if we look at home equity as sort of an indicator of whether or not we're in a bubble, here in Canada, we're about 65%, I believe it is. And in the U.S., just prior to their bubble, they were 63%. So the point I often make on my blog is, yes, it looks great, but it's no predictor of future house price movements. And I would much prefer to look at how our debt levels are, and
where do assets play in the role? Because I recently attended a CMHC conference saying asset growth, and this includes savings, I would know, which are record lows right now, but also stock portfolios and people's houses have far outpaced debt growth in the past 10, 15 years. So it shows that Canadians have more assets. And how does that play a role with comparing to the U.S.?
That's a great question. I don't have those stats off the top of my head. One thing I would point out, though, when you start looking at when you're in, if we are in fact in a debt bubble,
yes.
okay, let's assume for a second, what does that do to the broader economy? For one thing, if people start spending more money than they otherwise would, if they're taking on debt, it's actually fantastic for the economy in the short term. It buoys consumption,
yes.
And that alone is about over 50% of our GDP here in Canada.
Yes.
So if you are in a debt bubble, it would stand to reason that you would see
economy.
corporate profits rise and so on. So that fact alone, again, doesn't predict what house prices are going to do in the future. And I think unless you start looking at measures of fundamental value and how house prices have deviated from that, then we're way off the mark in really discussing a bubble.
Okay, excellent point. Ben, one thing, Capital Economics reported that the number of the number of vacant new construction units are up to where it was in 94, 95. So unoccupied housing units are at levels that were when the market wasn't doing so well. What's your thoughts on this with respect to Toronto and the GTA?
Well, in terms of the condo market, in terms of new condominiums, most projects that are coming to occupancy are 95 to 100% sold. So, if it's similar to the levels in the late 80s and early 90s, it's just simply for a fact that there's so many more projects on the market. You know, there's at the end of this quarter there will probably be 300 active new condominium projects. So, even with 3 or 4% of those units still vacant or unsold when the projects come to market, it's still not a huge percentage of the overall market. And we're going to have somewhere in the range of 80,000 new condominium units in those 300,000 projects. So it's not alarming to me in any way, and it's interesting how someone like Capital Markets can kind of bend statistics.
So Ben, you mentioned that I guess in previous times you were on the show that investors are driving a lot of the market. It could be anywhere from 40 to 60% of all sales. But I also saw an interesting fact from CMHC that 80% of the units are owner-occupied in condos. Why is there that disconnect with a lot of investors in the beginning, but 80% of the units are owner-occupied?
Well, it's interesting. We used to say, and this was probably back not only about 5 years ago in 2006, that only 30% of the units were being bought by investors. It's only over the past 5 years that we've really cranked that up to anywhere in the neighborhood of 45 to 60% overall in the Toronto CMA. So, and again, we're seeing a much higher level of assignment activity as well. So in the neighborhood of 10 to 15% of units are being assigned. So a lot of those times assigned.
An assignment just for people that.
So these units are actually being assigned to end users, which are living there. So CMHC's study where they poll property managers. I mean, I'm not sure how property managers can really know in a 600 unit building, how many are owner occupied or not, or if the owners are actually letting the property manager know that there's a tenant in there, right? So. Yes. How reliable is the CMHC number? I think it's probably fairly accurate, but I think we're definitely going to see those numbers really go up over the next few years as some of these downtown projects.
In terms of the amount of renters or tenants or unoccupied units that are coming up. Is that what you mean in terms of when you say the number is going to change? Yeah,
I mean it's definitely going to go up because we're going to see these investor held units that are occupying in the future have higher rates of renters in them. Yeah.